In this presentation, we will continue on with our corporation comprehensive problem with the issuance of stock. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Our data is going to be up top. We have the issuance of stock. We have the shares, 4,000. We have the par value, $5. We have the amount received per share, $20. Number of shares for equipment, 2,000, and equipment valued at 20,000. So this could look like a lot of information, and it is, to look at the issuance of stock. What's really happening here, there's two types of transactions we are looking at. We're issuing stock, one for a cash transaction, and then we're issuing stock for equipment. So we'll break those two out into two separate types of journal entries. So let's focus here then on the first one. First, we're going to issue stock for cash. So we have 4,000 shares. The par value is $5. The amount received per share is $20. What does that mean? Why are these two, par value and amount received, why are those different? The 4,000 shares are pretty straightforward. Note that what we're doing here is issuing stock. We're issuing ownership in the company through the issuance of stock. So we are the company. We're issuing the stock to owners of the company, and in exchange for that ownership within the company, they're paying the company, giving the company money. This is similar to a sole proprietorship, that if the owner was just to put money into the company, an investment of money into the company. So that's in essence what's happening. The owners of the company are putting money into the company through the company issuing stock in order to represent that ownership within the company. We could do that with either by receiving cash within the company or something other than cash, such as equipment. The par value is just going to be an arbitrary number for a corporation, and that's going to be helping us to standardize the corporation. So when we look at common stock, it will then be standardized by units of $5. So it's just an arbitrary number. It has nothing to do with the actual sales price, but it helps us to just really look at the information and see everything in terms of like a standard unit of value. And of course, we're not going to sell it for $5. We're going to sell it for something over pretty much all the time, almost always. And so, in other words, the par value is going to be something that should be far less typically than the actual market value of the stock, and we'll sell it for the market value, which will be something higher. And any difference that we have, we're going to put into additional paid-in capital. So that little difference right there is what makes the issuance of stock a little bit tricky, because these two accounts, common stock and additional paid-in capital, are kind of related. They're basically the same type of account. It's just that common stock we're going to standardize, and we're going to put everything else into additional paid-in capital. So how would we think about that? Well, we're going to say we're going to issue this stuff. We got 4,000 shares of stock. So we're going to take the stock, 4,000, and I'll multiply that times the market rate, which is $20 times 20. That's going to be 80,000. So that's how much we're actually going to get. We're going to get $80,000. We're going to credit only 20,000 to the common stock, however. And how did we get that? Well, we're taking that same 4,000 shares, but only multiplying it times the par value, which was $5. So there's the 20,000. And this represents equity going up. The difference between the 80 and the 20, the credit that we need to be in balance, in other words, is going to be the additional paid-in capital. So you can see that these two represent equity sections. Here's the equity section. These two represent the equity accounts that will be increasing in the credit direction, representing that the company owes the money back, in essence, to the owners. And then, of course, cash is up here. Cash is going to be increasing. So the journal entry is going to be an increase to cash, and it's going to be an increase to common stock and additional paid-in capital. That's going to be our first transaction. Now we have the same thing happening, except this time we are issuing stock, but we're getting equipment. So the equipment is going to go on the books for the price of the equipment, in this case 20,000. Now that might be something we'd have to kind of figure out in practice. Obviously, if it was a retail price, if we know the price of the equipment, if it sells on a market, then we would know what that is. It's also, note, this is kind of like a transaction that's happening here on a free market transaction. We are exchanging equipment, not for cash. We're getting equipment, the company is, in exchange for value in the stock. So that free market transaction will help us kind of value the equipment. But if we know the value of the equipment, the market value of the equipment, then we can put that on the books, and then we can figure out what the amount should be applied to the additional paid-in capital and common stock. Obviously, in a book problem, they would probably give us the value of the equipment. In practice, we'd have to figure that out by using market rates or market terms in some way. So then we're going to say that the credit's going to go to common stock. And again, how do we get the common stock? Well, we're going to issue 2,000 shares, and it's $5 times $5 par. And that's going to give us our 10,000. And then we've got the difference. The 20 minus the 10 is another 10,000 that's going to go into additional paid-in capital. So these two are similar. It's just that this one we got cash, this one we got equipment. Assets still going up. Here's the asset of equipment. It's going to be increasing. Then we're going to credit the common stock and the additional paid-in capital. So the assets are going up, common stock equity is going up. Let's see what will happen when we post these now. This is the process of journalizing the journal entry. Now we'll post them to the general ledger. Now here's just an overview of the general ledger so you can see the entire general ledger and how it will be used to create the trial balance. We're going to pick the accounts now that are going to be used in order to create this journal entry. The general ledger, notice, is very intimidating looking, but it's in the same order as the trial balance. Trial balance is in order: assets, liabilities, equity, income, and expenses. General ledger, same order: assets, liabilities, equity, income, and expenses. So we've color-coded those: assets green, liabilities orange, equity light blue, income and expenses in the dark blue. So that'll give us a little bit easier to hopefully find this in the worksheet. We're going to zero in now on the accounts that will be affected by our journal entry. Here's our journal entry. Cash, first one. So if we look at the cash account on the GL, it started at 0. We're going to increase 80,000. So we're going to enter 80,000 in the debit section, and that'll bring the total balance up to 80,000, from 0 up in the debit direction to 80,000. Note that we're representing here debits and credits on the worksheet, but the balance we're going to represent with a credit only with brackets. So these brackets are representing credits for us. They're going to be used as negative numbers like in Excel, but for us we're going to say the brackets also represent credit. So here we're representing the fact that this 20,000 is a credit two ways. One, it's in the credit column. Two, it has brackets. This is a debit for two reasons. One, it's in the debit column. Two, it does not have brackets. This will help us to simplify our worksheets in some cases. For example, here, if we didn't use that format, we would have to have two balancing columns, a debit column and a credit column. Instead, we're just going to represent with brackets or non-brackets in this column. This will also help us a lot with the worksheet. And it's just one of those, when we get to the adjusting entries, it's just one of those things that we really need to get used to, because we're going to have to deal with different formats to see debits and credits. When we use a different software or different formats of worksheets, they'll often represent debits and credits with brackets or non-brackets, with indentation or non-indentation. We got to learn a couple different ways to note that and the reasons for them, because it really helps us to format our worksheets a lot easier if we use some of these techniques. Next one, additional, is going to be common stock. So we're going to go to the GL for common stock, enter that in the credit side. So this is a credit, this is a credit, bringing the credit balance up in the credit direction. And again, we note it's a credit here because it's in the credit column. But here we're just basically noting it's a credit by having the brackets around it. In other words, we're not going to have two balance sheet columns. We're only having one balance column here. And that's going to be a credit column. And that's all we really need for most of the accounts, because most accounts have a normal balance of a debit or credit. And therefore, we only need one balancing column. It's kind of a waste of space, in other words, to have two columns here. We could break this down to one column too and have the debits be negative, or debits be positive and the credits be negative. But we're going to give a little bit more detail in these two columns, and then break it out in the balance to just debits and credits, debits, positive, credits with the brackets. Then we're going to have the additional paid in capital, so we'll find that. We're going to post that to the general ledger. This is the process of posting. So here's the additional paid in capital. Starts at 0, goes up by the 60,000. So here's the 60,000 to 60,000 credit. Okay, now we're going to post the second transaction. Here's the equipment. We're going to post that to the GL for equipment. It's going to go from 0. We're going to fill in the 20,000, goes up in the debit side by 20,000 to 20,000. Then we'll go to the common stock. Here's the common stock. It was at 20 before. We're increasing it by another 10,000. That's going to bring it up to 30,000. So our running balance here in our general ledger is up by 30,000. And these are the accounts that you can think of like a T account. So here's basically the T. We have the T going this way. And then we have more than a T because we have the running balance over here. So a lot of times if you were doing this by hand, the running balance, I think it's worth doing. But if you wanted to simplify the process, you could do the entire problem and add up vertically. Add up the credits, add up the debits. And you'll say the credits are minus the debits. And that'll be that. So we could do it that way. That would be a normal T account. But it's really worthwhile to have the running balance. If you have a computer system, clearly the running balance is easy to do in Excel or any kind of computer system. And it's worthwhile to do by hand too, because what we're going to do is use this running balance in order to create the trial balance each time so that we know we're in balance, number one, and number two, we can just analyze what is happening as we go, which will get a better idea of the system. Then we have the additional paid in capital. Here's the additional paid in capital. So this is a credit. We're going to credit it. It was at 60,000. We're going to increase it by 10,000 to 70,000 in the credit direction. So these are the accounts that are affected. If we look at the entire GL then, our GL should look something like this. So here's our GL. I know it's a little difficult to see when you zoom out because the GL is such a, so much activity going on. But here's our cash account. So our cash account, and I obviously put an 80,000 for all of these because that's how the worksheet works. You're only going to have an 80,000 in your PDF in this first account. You don't need an 80,000 all the way down. But the 80,000 here, in essence, the bottom line 80,000, is what's being used to create the trial balance. And then we've got the equipment. So here's the equipment account. It was at 0. It went up by 20. Again, you probably only have 120 here. You don't have to repeat the 20 twice. But that's just how this worksheet will work from a computer system. So this is being used to then create the equipment. So this is what we want to fill out on our trial balance now. The trial balance is going to have 80,000. It's going to have equipment, an asset of 20,000. And then we're going to say that the common stock, if we look at the common stock, if it was at 0, we increased it by 20 and 10 to 30,000. That's what we're going to use to create the trial balance, 30,000 here in the credit side. And then the additional paid in capital had the 60, the 10, bringing it to 70. That's what we're going to use to create the trial balance. So we're going to use the GL now to fill out the trial balance. And recognize the debits and credits. We don't have debits. I'm not showing debits and credits on the trial balance other than the positive numbers being debited, negative numbers being credits. And that will allow us to quickly see that we're in balance by just doing some math, by saying the debits minus the credits, this debit plus this debit minus this credit means that we are in balance here. Now again, a lot of problems will have you do the entire problem before you create the trial balance. But I highly, highly recommend doing the trial balance as you go and just print out a different trial balance if you have to each time, or just work with a new problem each time. Because now you can really think about, okay, what happened after this transaction as we go? Does this make sense? Well, the assets went up, the green accounts went up, the equity went up, and nothing happened in terms of revenue. Revenue didn't go up at all. So if you think of our accounting equation, assets equal liabilities plus equity, then the assets went up and the equity went up. And that should kind of make sense because the assets are what we got in the company, and we basically finance those assets with investments from the owners. The owners put in those assets, meaning the owners paid or invested in the common stock, in the ownership of the company. So this basically represents what is due back to the owners in a way. So this is an asset here. Obviously we've got cash and the equipment of 20,000, and that's what is owned by the company, and it's all due in essence right now back to the owners, represented by the common stock and additional paid-in capital. So in other words, if we were to sell this company or liquidate it, then of course we would sell the equipment, hopefully for $20,000, and we would have $100,000 of cash, which we can then give to the owners in accordance with whoever owns the stocks. For more accounting information and accounting courses, visit our website at accountinginstruction.info.